So now this level is incentivized to attract price, and it will act as a magnet for price to later do what? Run over this level. So now you have evidence that that level was valid, and retail traders might be a part of that move. So anybody that purchased price at that level, their stop losses would go on the swing above. And what does that reverse indicate? That indicates a trap, a stop hunt. And what is the function of the stop hunt? The stop hunt is a price is breaking through this level, and price broke through this level, but what happened? Price came back into the range form. So how would you trade liquidity and inducement? Of course, you can trade liquidity in a continuation form, but let's focus on the inducement part. So first of all,
getting filled on a passive limit order isn't execution success, it's smart money dumping toxic flow right before a crash. Institutional participants do not view resting limit orders as price support, but as easy exit liquidity to absorb. Toxic flow.
So what is liquidity? In simple terms, liquidity is an area or a level where business was conducted previously. Institutions purchase a price at a specific level, and some retail traders end up taking advantage of the institutional sponsorship and take the trade. And our main objective here is to find out where these retail traders' stop losses rest at. So in this example, you can see price being purchased at this demand level, and we're not focused on the entry or why price was purchased there.
Static bid sitting on an electronic ledger aren't protecting your entry, they are merely serving as guaranteed fill targets for institutional rebalancing. Smart money algorithms actively search for dense clusters of passive limit orders to execute large volume without moving the market against themselves.
Price being purchased at this demand level, and we're not focused on the entry or why price was purchased there. We're looking at if some retail traders took advantage of this trade, where would their stop losses rest at? Their stop losses would rest at the near swings. And this is where the liquidity will be rested. So let's get into this. So the first type of liquidity we're going to cover is your support and resistance liquidity, which
high frequency. Algorithms don't respect your limit bid, they exploit it as friction-free fuel to complete their portfolio shifts, leaving a static order in the order book. Grants informed traders a free, unpriced option to fill you only when market conditions turn hostile.
Let's get into this. So the first type of liquidity we're going to cover is your support and resistance liquidity, which is your equal highs and equal lows. As you can see, price found resistance at this specific level. What does that mean? That means institutions sold at this level, and retail traders might have taken advantage of this. So now this level is incentivized to attract price, and it will act as a magnet for price to later do what?
If momentum is on your side, fast traders cancel ahead of you. The market turns toxic. Your limit order gets filled instantly. When retail traders stack resting orders at predictable support levels, they engineer an irresistible magnet for institutional order flow.
Taking advantage of this. So now this level is incentivized to attract price, and it will act as a magnet for price to later do what? Run over this level.
Technical support is often an illusion that entices price to sweep right through and trigger a wave of liquidations. Adverse selection occurs because informed market participants only trade against passive quotes when they hold a short-term speed and information edge.
So as you can see here, price is finding resistance, and this level will be used as a magnet for price to run through it. So next, we're going to cover the trend line liquidity. If you look here, you don't see equal lows. You can't pinpoint where the resistance is coming from.
An immediate fill on a static limit order usually means smart money knows something you don't and just dump toxic inventory into your hands. Stacking passive stop and entry orders along popular visual trend lines builds concentrated pools of liquidity ready to be harvested.
The resistance is coming from. Now, it could be coming from internal liquidity, but a lot of times retail traders use what you call a trend line. And now liquidity is resting underneath the trend line. So now that trend line becomes a magnet to attract price. So here we have an example of trendline liquidity.
Algorithmic market makers routinely doctor price through obvious trend lines too. Sweep every resting limit order stacked along the diagonal. Retail traders often use limit orders to avoid paying the spread, ignoring that adverse selection costs far more than the bid-ask gap.
So here we have an example of trendline liquidity. Price rejected from the trend line and attracted price. So next up, you have your FTB, your fail to break liquidity. As you can see here, you have a supply level formed and price approach.
Saving a single tick on transaction fees is useless when the fill puts you 30 ticks in drawdown within seconds. Repeatedly testing a key supply or demand level drains resting institutional limit quotes until no passive defense remains.
See here, you have a supply level formed and price approaches this level and rejects. So now you have evidence that that level was valid and retail traders might be a part of that move. So anybody that purchased price at that level, their stop losses would go on the swing above. And above that swing would be resting the stop losses, which would be your liquidity. And price would be incentivized to attack that level one more time.
Once the defending limit orders are exhausted, aggressive traders break the level and sweep all lingering retail stops. Institutional market orders systematically absorb resting limit quotes level by level until order book depth collapses.
Attack that level one more time. So here's an example of your fail to break liquidity. Price formed the supply level, an aggressive reaction from the supply level, forming the liquidity to later be absorbed.
Sitting passively inside a thin order book means standing directly in front of an aggressive institutional sweep in severely unbalanced order flow. Static limit bids cannot stop institutional liquidation waves and simply get overrun.
Left, and you want to look to what happened previously. What happened here? We know that there was a supply level here. Price came to the supply level and reacted and broke structure. What can we understand from this motion? We can understand is that there were sell orders injected.
Institutional sell imbalances will slice through passive bids like paper, leaving retail buyers holding severe losses. High-frequency algorithms detect stale limit orders in real time and hit them right before structural price collapses occur.
Can we understand from this motion? We can understand is that there were sell orders injected here that pushed price down. There was so many sell orders that overpowered the buy orders here that pushed price down. So now we know if price comes back to this level, there's not enough sell orders anymore. Why? Because the sell order has been used here. So that means there's not enough sell orders to reject price one more time, and price will more than likely continue above.
Once institutional sell pressure exhausts local bids, price has no choice but to break higher or lower into thin air. When a dense spool of limit orders is fully absorbed, a sudden liquidity vacuum forms behind it, triggering fast slippage.
Order has been used here. So that means there's not enough sell orders to reject price one more time, and price will more than likely continue above. So this would be your FTB, your fail to break liquidity. So now you mark up your liquidity.
Breaching a keel limit order level clears out the book, allowing price to gap violently into empty structural space. Sweeping algorithms consume multiple price levels of passive bids in milliseconds to trigger stop cascades and displace price.
So now this area would act as a magnet and it would attract price.
What looks like a safe bounce level gets converted into an aggressive stop run zone within a single tick. Large displayed limit orders on the bid often act as phantom support, disguising the fact that smart money is actively unloading into them.
And the liquidity's been absorbed. Next, we have FTC, failed to close liquidity. And the main characteristic of this liquidity model is that the candle never closes below the range. It just wicks through. The candle wicks through, and that level becomes a magnet for price to attract.
Impressive depth on the order book can vanish or get absorbed right before an aggressive downward expansion, getting matched on a passive limit order during elevated market volatility is a primary indicator of severe adverse selection.
So what is the primary function of liquidity? So we know that liquidity will attract price. In due time, this level will be absorbed. But what happens next? Price can always continue above and completely continue with the trend, or price can reverse and come back into the range. And what does that reverse?
With order flow. Surges, fast participants pull their bids while bad limit orders stay exposed and get hit. Market makers intentionally push price past key structure to trigger by stop limit orders before executing a sharp reversal.
With the trend, or price can reverse and come back into the range. And what does that reverse indicate? That indicates a trap, a stop hunt. And what is the function of the stop hunt? The stop hunt is a trap. In this situation, everybody that thought this was a breakout, that price is going to continue higher, got trapped.
Stop entry limit orders. Smart money manipulates local order book imbalances to doctor price toward clusters where retail stop loss limit orders assemble.
And at the same time, the stop losses of who sold at the previous resistance point, their liquidity got absorbed. So let's take a look at this example. So here you have your demand zone. Here you have your order block. Price reacts from this order block. Price reacted from this order block and shot up and broke structure.
Electronic order books are, after passive liquidity at a demand zone is completely absorbed, subsequent retests lack defensive quotes and fail rapidly.
Price reacted from this order block and shot up and broke structure. So what do we know now? We know that there was the buy orders that were injected here were greater than the sell orders that could have been resting here. So now we know when price does come back to this level, it's more than likely going to break through this level instead of rejecting again. Why? Because there might not be enough buy orders in this demand order block.
Returning to a limit order level repeatedly eats away the remaining passive volume, guaranteeing adverse selection for late buyers. Massive institutional sell imbalances eliminate. Passive bid stacks instantly, sending price crashing through key structural levels.
Order block. So price is breaking through this level.
Attempting to buy passively during an institutional sell-off is like placing a paper shield against a heavy sledgehammer. Passive limit fills often occur at the exact turning point where institutional traders transition from takers to providers.
Price is breaking through this level. And price broke through this level. But what happened? Price came back into the range, forming the trap, the stop hunt. So the stop hunt has been formed. Everybody that tried to sell in this area. So everybody that tried to sell in this area.
Your passive buy order gets executed precisely as smart money finishes distribution, leaving you trapped at the absolute worst price. As soon as your limit order is executed, market makers widen the spread and adjust quotes, locking your trade in immediate drawdown.
Area, thinking this is a breakout and price is going to continue lower, got trapped right here. And everybody that purchased price right here, their stop losses got taken. And price will continue the opposite way.
Microstructure. Dynamics guarantee that by the time a static order fills, the short-term order book imbalance has already shifted against you. Algorithms create shallow price bounces ahead of major levels to trick retail traders into placing early limit orders.
The opposite way. That's the effects of a stop hunt. Let's talk about inducement. What is inducement? Here you have your point of interest. Price approaches your level, but doesn't get all the way to your point of interest and forms a reaction. What is price trying to do?
Engineered micro swings lure passive participants into opening positions early, positioning them perfectly for an upcoming liquidity sweep. Market makers leave obvious resting limit clusters intact, allowing total order volume to build up before conducting a full sweep.
Trying to do is trying to entice you into taking a position, tries to force you into abandoning your point of interest as if price is not going to reach that level. Price comes back, reacts from that same level and rejects, forming liquidity, engineering liquidity. They're trying to entice you into taking a short before price actually takes the liquidity, goes to your point of interest and reacts.
Leaving unmonitored. Limit orders resting on the book gives institutional algorithms time to map out exact stop-loss coordinates. Price sweeps through preliminary retail limit orders to gather necessary liquidity before reaching true institutional interest. Zones.
To your point of interest to later on actually visit your point of interest and then react from it.
Early. Limit buyers suffer maximum adverse selection, while smart money waits patiently for extreme discount pricing. Manual order cancellations cannot match the microstructure speed of high-frequency algorithms reacting to toxic flow signals.
So how would you trade liquidity and inducement? Of course, you can trade liquidity in a continuation form, but let's focus on the inducement part. So first of all, you want to locate the liquidity. In this case, here's your liquidity. What kind of liquidity is this? This is this.
While you manually review a chart, high-speed algorithms have already pulled their quotes and hit your stale limit orders. Institutional participants displaying on firm limit orders that are canceled instantly when market orders approach, leaving passive retail exposed.
This is FTC, failed to close. Why is it your failed to close? Because of this wick. So now you know liquidity is resting under this level.
Displayed support on the order book can evaporate in a single millisecond, isolating your limit order in a fast-falling market. The winner's curse states that when your passive limit order gets filled, it is usually because you mispriced the market relative to fast traders.
So now you know liquidity is resting under this level. So now you look for your point of interest. In this case, I'm looking at this discounted order block.
Informed traders only accept static limit quotes when they possess an edge, guaranteeing negative expected value for a managed limit orders. High-frequency market makers clear toxic short-term positions by dumping inventory against static limit orders sitting on exchange books.
So now what you're waiting for is for price to run on liquidity, go to your point of interest, and then react. So let's talk about the inducement secrets and what makes a valid inducement.
Passive limit orders function as primary exit liquidity for institutions liquidating large blocks during high volatility, placing limit orders inside fair value ranges rather than extreme premium or discount zones drastically increases exposure to toxic flow.
So here you have your range. This would be your range. So now we pull out our fib that's broken into 4. So basically the four parts are
fills that take place inside mid-range equilibrium zones almost always experience adverse selection before price reaches key structural levels. Surviving modern electronic markets requires viewing limit orders as dynamic positions that require constant order book filtering.
The 4 parts are 0, 25, 50, 75, 100. And this would be your discounted level, and this would be your premium level, and this would be your fair price. So what you would want essentially is you would want your inducement to happen you would want your inducement to be here. You wouldn't want your inducement to be here and then for price to reach your level or even close by to the premium.
Stop viewing limit orders as passive set and forget trades and start managing them as real-time liabilities subject to adverse selection. Stop reading limit orders as passive safe haven and start managing them as dynamic short gamma positions